How are you, folks? Enzo Di Costanzo, and today we're going to be looking at the no free lunches section of Breely Myers Corporate Finance. So let's hit that. Sorry, yeah. We're going to be looking at the no free lunches section of Breely Myers in the stock valuation section. So let's get right to that. I was this morning. I woke up and I was I was thinking about how to approach this, because we're spilling over into the spring 2023 from fall 2022, and everybody's studying for exams or working on the exam assignment and all those other things. So I was thinking of should I do an hour of this? So what I decided to do, or just do a very long in-depth video, because this is a key lecture for the spring. So what we are going to do is introduce the topic, even though it's within the chapter, but it's a big enough topic where it could almost be its own chapter. And our old friends here, assets, liabilities, and shareholders' equity, the way the accountants look at everything. Okay, this says, okay, market value balance sheet, sure, but still market book. You do the present value of what you think your future cash flows are going to look like. Okay, that's what we're working on right now. Okay, so we're hitting that. We're going to use returns for the S&P 500. Schiller, our old friend Schiller, up in Hartford, he has his own price to earnings ratio that he's sort of a statistically adjusted one, which I didn't dig into, but hopefully in the years ahead, I'll spend a little bit more time really digging into how Schiller's looked at that, and maybe a little more research time. Maybe I'll spend a little more time doing the research aspect of things instead of doing all the presentations. Okay, so as you sort of scroll through this, are we going to be doing technical analysis? Maybe a little bit. Technical analysts look at the statistical profile of what's going on in the markets, and look for patterns and things of that nature. The random walk guy, I took corporate finance with him. I think I do a better job. And yeah, I took the random walk guy for corporate finance long ago, 2 decades ago, in central lower New Jersey, and I think we use a lot. We use Excel a lot more than maybe things have changed years ago, but from years ago. I think we use a lot of good technology. But we're going to create this. See what it says? Each dot shows a return on the composite index. So this is the New York Composite Index from between 1970 and 2010. So those 40 years, and you can see that. 1 week you might have a 3% gain, another week you might have 5% gain. And does the previous week's gain have anything to do with the current week's gain? That's really so. The New York Composite Index. I'm not embarrassed to say this. I don't even know what that is. But what is there such a thing as? I mean, who knows? These guys. This book was written long ago. Okay, there is such. Okay, the Stock Exchange Index. Okay, I didn't see it. It says New York Stock and NYSE. Composite index. So again, lending to the I would pay more attention to those other 2 letters, maybe compared to the guys who I'm really going today, right? Criticizing Princeton, criticizing the guys who wrote the finance book, but I would have put the SE in there also. Maybe there's a reason they didn't do it, but could be copyright or something. But you're mentioning it, so I mean, what are you doing? But that's the index that they looked at. I don't know, the 5-year return for this. It's kind of scary, right? It's not, I mean, it's up, but it's not up in a decade to be, okay, this was what, 12,000, and now we're up to about 15,000. Okay, that's pretty good. And it's 5 years, so it's 3,000 over 12. All right, so 25%. No, 25% over 5 years. That's pretty good. No, that is pretty good. So it's the way it's presented. A lot of these years here, you're sort of back to where you were just before the pandemic, and then you had a lot of movement here. And I'll tell you, with the 2020, you had a dip, but you didn't have a gigantic dip. So these companies held their value, and you're hearing a lot of the powers that be out there, the Rubensteins of the world, saying, "Oh, well, valuations are going to be impacted." Well, yeah, of course, valuations, because earnings are going to dip a bit because of higher debt costs, and we're gonna that there's an impact, there's a valuation impact for that. Okay, that's just something to keep in mind. Okay, are we sharing? Yeah, we are sharing. Okay. So, yeah, so what we're gonna do is we're gonna create this, but with a different. I use the S&P 500. This is monthly returns. These might be weeks. I did months and years. These guys did weeks and months, kind of a thing. And then some of these other graphs that we looked at here. This is the uh, Standard and Poor's index. Yeah, this is just the index level over the years. Why are there two? And it says, yeah, this shows the results of playing out. Okay. Yeah. So the first one, okay, I see what this is. What they're trying to tell you is you're looking at the returns of the S&P 500 over 5 years and looking at a just toss the old tossing a coin or throwing a dart at the dartboard and trying to predict where it's going to land. And they're saying that these are too similar, and then they're right. They're pretty right. Now, I how see this is sort of the classic random process, sort of an outcome tree is what this is. You toss a coin, you get heads. You toss a coin, you get tails. You have the payoffs, those kinds. And again, I didn't dig as into it as I probably should have in the chapter. Again, myself included, as the years tick off the sort of the calendar here. Yeah, I concentrated on the valuations. I didn't do too much of uh, the technical analysis stuff. But as the years tick off the calendar, myself included, you learn better, or you learn more. Your depth increases as you get through the material. But yeah, so this is obviously, and they created an index out of that payoff kind of a thing, and that though that the behavior of that game and the behavior of the New York Stock Exchange Composite Index, you could see are rather similar, rather disturbingly similar. No. Theory fitting facts, sure. Efficient markets. I'm not the greatest efficient market believer that there is. Um, this is comparing this. I think we talked about it in the PowerPoints. This is a graph comparing just the Wilshire 5000 and a managed, uh, I think a managed fund over 40 years or something along those lines. And I think if you look here, if the purple one is higher, it did better. It did better here. And obviously, in terms of losses, you want to lose less. Um, yeah, I mean, it looks like they beat the mutual fund a lot of the time. But again, when you're cherry picking your endpoints in a sense, and that has a lot to do, with this. Your personal financial planning is your decision, and you should treat it like, see, Warren Buffett would say, "Oh, just leave your money in the S&P 500 and you'll be fine. And in 40 years, it'll be worth a lot more." But what if the day that you're retiring or when you start to need that capital, you're in the Great Recession or the pandemic hit or something? And can you wait 3 more years for an improvement from that point in time? I don't know if you could really do that. So that's and Buffett should know better. I know what he's trying to communicate. And again, I've said it a number of times with Warren Buffett. Warren Buffett uses his image as sort of America's investing grandfather to further the valuation in his portfolio. Don't ever think he doesn't do that. Okay, he definitely does that. And that hey, I think all of us would take advantage in a sense where you're looking for a certain outcome that benefits you, and if you could take advantage of your image, you would do that. I think there's a lot of that happening. I see. You can see everything's returns. This is returns over 6 months, and this is but then the quarterly earnings and how the earnings were reported, that kind of a thing. It didn't say if the earnings were good or bad news for some reason, but it's at least, hey, at least you know what the company's looking like, kind of a situation, right? But there's the no free lunches section, bubble. That's a good section. No, this is behavioral finances in here. There's a lot of good reading. They wrote it like a feature in the Wall Street Journal or something. Even though the Wall Street Journal doesn't have a lot of features, but they wrote it like a feature in there. Yeah, this is all really good material. This graph, I struggled a little bit trying to think about this. I'm sure they understand, but it's communicating it to us is always the big piece of this. Okay, so like I said, so this is the no free lunches section of the chapter. We have a lot of statistical stuff that we're going to be working on, so we're going to get back to this. So we're here, and actually, what I'm going to do just to remind myself where we're coming and going from. We'll put that in there. There we go. Stay in the. That just reminds me sort of where we are. I mean, we have some other manipulations to do, but what I want to do. So we have this notice here. We have yes. See what says T-1. T is today. Time is that sign. T is 1 is yesterday. How yesterday was doing. We could do month-over-month changes, year-over-year changes. We're going to download the data. But before we do all that, and again, yeah, who knows how much statistics you know that you don't know, kind of a thing. So we're going to just introduce a couple vocabularies here, and we're going to be going back to and referring to these. So what I decided to do is, of the 10 sets of notes or so that I have here, I might just read a couple minutes each, and then we'll work on the model, start setting up the model, and then we'll stretch this out over maybe a couple of videos. Variance is a measure of the spread between numbers in a data set. It measures how far each number is from the mean. The variance is calculated by taking the difference between each number in the set and the mean, squaring the difference to make them positive, and then dividing by the sum of the squares by the numbers of the values in that set. Okay. That's really what that is. It's used in statistics for probability distribution, since variance measures the variability from an average or mean, and volatility is a measure of risk. The variance statistic can help determine the risk an investor might assume when purchasing a specific security. A variance value of 0 indicates that all values within the set of numbers are identical. All variances that are non-zero will be positive. A large variance indicates that numbers in the set are far from the mean and each other, while small variance indicates the opposite. Okay, but that's what a variance. Again, it's really the first couple lines here. It's the distance between each data point and the mean. Okay, which is what that. Pardon me for. Volatility is a statistical measure which measures the dispersion of returns for a given security or market. Okay, and that's a real Wall Street term. And we'll get to this R squared and all this other stuff. We'll get to all that. But folks, this is a whole chapter in the statistics textbook, which we might be touching a bit in the spring. It's a statistical measure of the dispersion of returns for a given security or market index. Volatility can be either measured by using standard deviation or variance between returns from that same security or market index. Commonly, the higher the volatility, the riskier the security. Okay. Volatility is associated with big swings in either direction. When the market rises and falls more than 1% in a sustained period of time, it's called a volatile market. Market volatility can be seen through there's an index that measures it. Of course, we love an index. And the VIX was created by the Chicago Board of Options Exchange as a measure to gauge the 30-day expected volatility of the U.S. stock market, derived from real-time quotes of the S&P 500 call and put options. Okay, it's a gauge of future bets the investors and traders are making on the direction of the market and individual securities. A high reading on the VIX implies a risky market. Okay, so that's volatility. We have a couple definitions of it. It's an amount of uncertainty or risk related to the size or changes in the security market. And actually, I threw these together, whenever in previous my previous incarnation of my existence. I sort of threw these together, cleaning them up a little bit. Beta is a measure of the relative volatility of a particular stock to the market. That's beta. It approximates the volatility of security return against returns of the relevant benchmark. That's another a good sort of exercise that we could work on. So if the beta is 1.1, that means you're 110% movement in the stock valuation for every 100% movement in the benchmark. Okay, so you may have seen that in other classes. Covariance. So and then now we're starting to get into the sort of the Rutgers mathematics world here. Covariance is the measure of the directional relationship between the returns on two risky assets. A positive covariance means the asset returns move together, while a negative covariance means returns move inversely. Okay, you analyze at return surprises, standard deviation from expected return, or by multiplying the correlation between the two variables by the standard deviation of each variable. Okay, because now, so now you're getting into more. It's multiple variables now. It means it's that asset returns move together on two risky assets. That's covariance. Okay, they have a significant application of finance in modern portfolio theory, which I'm not really a big proponent of, and capital asset pricing model, which I don't. Again, not that I can do all these things, but it just our work is again, it's very specific deal based. And I'm not saying these things don't mean anything to me, but I'm not saying they don't mean anything to me, but it's you know, we have different we have different concerns or different things that we focus on. So the covariance of security in the market is using the formula of one of the model's key variables, beta. The CAPM beta measures the volatility or systematic risk of a security in comparison to the market as a whole. All right. It's just obviously systematic risk is what affects all the stocks out there. That's really what that is. It draws from the covariance to gauge an investor's risk exposure to one specific security. And now we're getting into portfolio theory. The standard deviation is a statistic that measures the dispersion of data set relative to its mean and is calculated as the square root of the variance. It's calculated as the square root of the variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there's a higher deviation within the data sets. Thus, the more spread out the data, the higher the standard deviation. Okay. So we have the standard deviation definition, and what's the difference between the standard deviation and the mean? So we have the definition of the mean, standard deviation versus the variance, what correlation means, what beta is, what R squared is. Okay, so there's a lot of terminology here. Like I said, we're going to keep going, but there's a lot of terminology with all this. Mean is the average of the data points of the set. Now, here's the thing. Our data points for this example are percentages. You're always, and it's rare for me to really use something like that, but the industry uses it a lot. It says, what are the returns? I'm looking at a more atomic level, because returns, you're getting further and further away from the accounting data that tells you really what's going on with the company or what's going on with the specific market. You're just taking percentage changes. And I think understanding gets lost in these percentage changes, in my opinion. That's just my opinion. But I think that some understanding gets lost in looking at it like that. So a closing price is in US dollars or euros, and that you get a percentage. You could have the same percentage change in the stock that costs 100 euros versus one that costs 3 or 4 euros or $3 or $4. Markets are fickle. Traders and analysts use moving averages that adjust daily to incorporate most recent data. Again, we say all these things, but this is, the statistical work that's out there. That's all over the place. The standard deviation calculation is based on the mean. It's the difference between each data point from the mean, and it's squared, and it's summed and averaged to find the variance. The variance is derived by taking the mean of the data point, subtracting the mean from each data point individually, squaring these results, and then taking another mean of these squares. The variance helps determine the data spread size when compared to the mean. As the variance gets bigger, more variation in the data values occur, and there may be a larger gap between one data value and another. If the data values are all close together, the variance will be smaller, the more difficult to grasp than our standard deviations, however, because variances represent a squared result that may not be meaningfully expressed on the same graph as the original data set. Okay, what are they used for? Is a lower standard deviation preferable? What's correlation? In finance and investment industries, the statistics that measures the degree to which two securities move in relation to one another. Correlations are used in advanced portfolio management. Computers, the correlation coefficient, which has a value that falls between -1 and +1. So you have a correlation, then you have a correlation coefficient. Okay, so positive correlation means the correlation coefficient is exactly 1. This implies that as one security moves either up or down, the other security moves in lockstep in the same direction. A perfect negative correlation means two assets move in opposite directions, while zero correlation implies no relationship at all. Okay, you have that. Large cap mutual funds have high positive correlation to the standard S&P 500, very close to 1. Small cap stocks had a positive correlation to the same index, but it's not as high as generally around a 0.8. So yeah, now again, these guys are making these conclusions based on the behavior of small cap stocks and whatever, the S&P 500 and large cap mutual funds. And I don't have the tread on the tire to go into that. I just don't look at things that way. But the portfolio guy looks at the whole spectrum and then tries to just really make a decision based on some sort of statistics, as opposed to looking at a specific deal, which is what my work is. The correlation coefficient is a statistical measure that calculates the strength of the relationship between the relative movements of two variables. The range of values of the correlation are bounded by +1 and -1 on an absolute basis. So the correlation is greater than 1, less than 1. It's if you made a mistake, you made a math error if you're above the absolute value of one way or another. Okay, and 0, there's no relationship. -1 is a perfect negative correlation. +1 is a perfect positive correlation. Okay, so the correlation coefficient measures the degree of relation between two variables. Okay, and it repeats things here again: how to compute it, what a beta is. It's to measure the volatility or systematic risk of a security portfolio and comparison to the entire market or the benchmark. It's used in capital asset pricing models, which calculates the expected returns of an asset based on the beta and expected market returns. Beta is also known as the beta coefficient. And again, this is further in there's about 3 risk chapters in this textbook. We were 216 here. Control home. A lot to get to the table of contents, right? And now it's not responding. There, just what I was so whatever. This is 2025 or something, whatever. That was the page I wanted. The brief contents is 27 of 25, whatever that is. But yeah, so there's he says introduction to risk, opportunity cost, risk return, weighted average. That's the risk part. So we're going to concentrate on the valuation part in the spring of 2023. We're going to look at net present value or sorry, valuing stocks. We might even do a little time value of money. Okay, we may spend some time in all these different areas, but all really important. All very important to have an idea. I taught this at Rutgers long ago, mergers and the options chapter there. I remember teaching these in the graduate school a couple times. This stuff I got to these 5 chapters I haven't spent too much time. It's actually 7 chapters, right? But they're good though. Introduction to corporate finance, how corporations. I'm sure if you read through them, I'm sure they'll be a good read. It's the book thins out as you go a little bit deeper into it. The tougher these are certainly the tougher chapters. But this is risk return and all that. Okay, that's all in there. This is the return on the asset, return on the market, and I use the subscripts very faithfully, a lot. Okay, so this will all be posted, so don't be concerned about did you get it from the video lecture or not. All that stuff will be posted. Okay, like I said, there's more to all this, and then here the Dow Jones Average, the Dow Divisor. I remember I taught that at NJIT a great while ago. Nasdaq versus the S&P 500. The S&P 500, everything that you need to know, what market capitalization is, what price weighted indexes are. Okay, so we're going to pick one of these maybe because we're dealing with the S&P 500, and then we'll get some of the data in. We'll go to Yahoo Finance, and we'll see how far we can get with this. And like I said, maybe we might stretch this out over a couple lectures or so. And this is valuation for today. So we're here with this. We don't need this. This is the address of the last lecture. And in terms of what it is we're talking about here, what did we talk about? We did a little S&P 500. Hey, we put a few definitions up here, covariance and different things. What the R, I think we discussed what the R squared was somewhere. We'll get to that, and we don't worry about that. We can get to that. So, and this is the beta. Warren Buffett criticized this the whole beta thing. I remember that. Like I said, there's what the Nasdaq is and all these things. But here, let's what this S&P for. It's a single financial barometer. And indicates the strength of the economy. We don't need that question. There's a period. The Dow Jones is well known, but it's rather small. Um, it's the S&P is the de facto numerical indicator of the U.S. economy. Okay, but it's got a deep importance. It's got a very deep importance. Oh, there we have a nice little set of text up to put on online. We'll post this in a little later today. It's a de facto numerical indicator of the economy. Gets second bill into but I don't know if it's. I think it's to me it's stressed pretty important. But again, who knows when these notes were written? It's an equity index made up the 500 largest companies traded on either the New York Stock Exchange or the Nasdaq, so the Chicago Board of Exchange. It's calculated by adding the company's float adjusted market capitalizations. In order to be included in the S&P 500, a company must meet the certain requirements. Now, the Dow, how these things are computed, and again, I have to look back at the notes for last semester about exactly how we did with the Dow Jones. The Dow Jones started by taking the prices of like the first 10 stocks that were in it, the first components, and just dividing. That was the Dow Jones. That was just dividing that by 10. That's what the price of. That's how the Dow Jones index was initially determined. Now there's a divisor and are you adding up the price? I think it's still done that in a sense that the divisor is rather complicated how it's statistically assembled. Then there's a market capitalization version. There's a price version of these indices. And just like in economics, you had those the inflation measures. You had quantity indices, price indices, and all that. So float adjusted market again. This is a market capitalization based version. To be included, the company must meet certain requirements, including a specific market capitalization. A majority of the shares must be in public hands. It must be a public company, so you get to all the legal requirements for being included on these indices. Investors who want to invest in the S&P 500 can purchase an index fund or exchange traded fund that seeks to match the performance of the S&P 500. Okay, how it works? It was and the etymology is a study of words. It says S&P were for the two people involved in creating this index, and those are Standard and Poor are two persons. One of them was a financial analyst. The other guy was a statistician. So that should tell you a lot about how important the the people, even whatever that was in the 1800s, said, "Hey, we need financial market expertise, and we also need mathematical expertise." And these things were probably this was the internet before you had an internet. You had a book that listed the public held railroad companies, and so Poor Henry Poor was that guy, and it merged with the Standard Statistics Company, and the 500 were the stocks that comprised the index. So it's always I always love the history of uh, how Wall Street grew and what happened in New York and Value Line and all the different personalities that were involved in it. So the index includes 500 largest companies where the stock trades on the New York Stock Exchange or Nasdaq. The components are selected by a committee and the College of Cardinals. That's fine. Okay, we're making relationships to the Oscars and the Rome and all this. It says like the College of Cardinals and the Academy of Motion Picture Arts and Sciences. The committee operates within specific criteria. To qualify for the index, the company must have the following. So again, it's just a very loose set of legal requirements about a market capitalization of a certain size. The value must trade annually. At least 250,000 shares must be traded each of the previous 6 months. Most of the shares are in the public's hands. Had an initial public offering at least a year ago, and have positive some previous 4 quarters of earnings as well as the most recent. So this is almost how Warren Buffett would start analyzing companies. Believe it or not, this is the minimum market capitalization as of November 2021, which is a good year ago, that you needed to be. I don't know how this has changed, but here let's Google that and see if we could find it. Now it's down to 8.2 billion, so it's sunk a bit allegedly. This is according to 3 sources. This is June, so okay, that was June 2021. Yeah, this is where the 13.1 billion came from. Any of that. There we go. See, we sort of very quickly as we're discussing here. This is what need. What was this? See, I'll tell you, if you don't want this altered in terms of your formatting and all that stuff, just bring it over as text, which is what I did. Yeah, that's the 13.1 that was referenced there. So you can see very quickly we did a little bit of research, right, and determined the press release for that, and allegedly it's lower now. So it says 8.2, but again, you want a good source for that. If it was Wall Street Journal or something, I would like that, right? Because here you had an appreciating market is what you had here. I don't know, the Corporate Finance Institute. This is okay. This is recent. Okay, this is very recent. So what are these guys saying? Okay, so here's some good criteria here. All right. Well, we're reading this now, so we'll get to this at another time. So right there. And what does this say? This says it talks about it's outstanding shares times the current market price. That's market capitalization. The free float market capitalization times some sort of index here. Again, that's a measure. That's sort of the IWF is a statistics measure, and there's a divisor. So yeah, this is just very general, but this would need some research. The coverage between U.S. and the market cap should be at least 8.2 billion. So it's gone down a bit according according to whatever this is. According to and the Corporate Finance Institute, this is like the CFA guys almost. It's not them, but it's similar to that. According to October 2 months ago, it's down to 8 billion in index, right, or in a market capitalization to be included in this, right? That's what it said. Yeah, mostly at least 8.2 billion. So it's dropped, now again, I don't know how accurate that is, and how much of this we can believe with these guys. Yeah, this is 2019. So this is a while ago. This is 8.2 also. So who knows? That one might be older also. So you got to be careful with these things. You got to be careful with these things. Because people you can move a date around and there's no anyway, we're gonna move on, but you can move a date around a bit and it could be all sorts of things happening here. But anyway, anyhow, this was Reuters released this. I doubt it's from 13 to 8 in a year. I doubt that, but it could be. It could be. So among the different exchanges, there's several thousand companies. But the first criteria reduces the number alone to less than 1,000. So add a few more benchmarks. It's easy to see how the S&P 500. So yeah, so you're changing the how many NFL teams you're going to have, how many Major League Baseball pitchers you're going to have, how many people who are really world class. It's really not much different than that. Okay, it's really not much different than that. But yeah, but though it's going to be some kind of some sort of criteria to have an S&P 500 based on these conditions. Okay. Their stocks are come and go a bit. United Steel came and left, and Martin Marietta Materials came and left, or whatever it was. The technology, obviously, and you could see these indices become with railroads. Not that railroads aren't important now, but they certainly aren't as important as they were. Although, but I'll tell you, I don't just say, well, not that as important as they were a couple hundred years ago. I don't know about that. It's still pretty. All of a sudden, we don't have any railroads. I think we'll have the potential for a railroad strike. So to say, oh well, railroads aren't important any longer because now we're in the internet age. I don't know. I don't know about that. I wouldn't go with that. But this is just I recall looking at this. These are just a little bit of the backstories of, what companies sort of came and went left or got knocked down to. There's other levels of the there's like minor league versions of the index and things. There's the mid cap, and they move into different indices and things of that nature. That's really all it is. But here's some of the questions: Who keeps track of the S&P 500 constituents? How does a company get added? Does S&P 500 include Nasdaq traded stocks? It definitely does. What are the 10 biggest stocks on the S&P 500? I think we looked at this: Apple, Microsoft, Amazon, Tesla. This was based on April's numbers, but Meta, Facebook, Berkshire Hathaway, JP Morgan. This is these Nvidia is like an Intel, but they're like a graphics microprocessor. How important is that? I tried to play a 4,000 whatever that is, a 4K video the other day on my computer, and it crashed it a couple times. Okay, so I don't get up to a certain high definition level of because there's just a lot of data that's involved in that file. Okay, but you see, you have market capitalization, you have share prices, you have shares outstanding. Okay. It says for the bottom line, it says for the most part, the S&P 500 doesn't convey information that differs drastically from the comparable indices. It broadly matches the more exclusive Dow Jones and more inclusive Russell 2000. Represents a happy medium between the very exclusive Dow Jones and a little broader Russell 2000. Comprehensive enough to indicate the relative strength and weakness of the larger economy, but not so exhaustive as to include too much noise with the signal. Overall, the S&P 500 is the index of indices, which bellwether adopted by analysts, policymakers, ordinary market participants alike. And we did a little bit of a comparison. The month over month, there was a lot of movement. The month over month percentage change was pretty good. We took the average of that last year, or April, not last year, April. Okay. So that's a little bit of background on the S&P 500. Let's get some of the data up and running here. Okay. So what we'll do, I don't know if we're going to do all of this today because I want to. There's still a lot of text I want to go over. But here, let's at least download the S&P 500 on a monthly reading, going back to the start of 1960. Let's do that. Okay. Again, once financial markets are aware of what the Federal Reserve is going to do, um, it sort of say, hey, at least we know what the future is going to look like, kind of a thing. The ticker symbol is GSPC. Okay, so yeah, you would think it'd be something a little simpler than that, but it's not. Does it say that here? Yes, I probably should put that in there. Okay. That's the ticker symbol. And you can see there's previous closes. We're going to look at historical data, average volume. There's a lot of volume today. We're going to do monthly data, and we're going to go back to 1960 until today. Yeah, it did it. I didn't say what my source was. Interesting. I should go back and find that video where I did all this and where this data came from. Yeah, folks, I have to look. I have to look up where that data came from. I have to apologize for that. Oh wow, it did it. It looks 78. It went back as far as 1978. Okay, well, yeah, like I said, I have that data, so we'll just sort of use what we have, and we'll just add on to sort of the remainder of it. But that's we should be able to figure out how to get that data to you guys in a better way, because I have it here. So now, unless it's from a couple years ago, they're not allow it had to be Yahoo Finance. It had to be that. But maybe they're just not allowing that anymore, all that data down. But luckily we have it. So anyway, let's go from 2019, the monthly. Let's go from 2019, because that's all we really need to do, just to add on to that. So we'll just do. I apologize for the little bit of a delay here. So um, yeah, what's my monthly data here? 2476.
Wells Fargo ha donado 390.
Yeah, from here out, we have everything, it seems. So we'll just add to it. And luckily, we have that data. And actually, so there, we dropped it off in there. So what we need to do here is these two axis indicators. We'll get rid of these things. Not get rid of them. We'll just move them down a little bit. There's our buffer is there. So we cast that. See, just folks, like I said, just getting the data can be a little bit of a chore. Don't think that it's not. That should be 20. Two. Okay, so we have all that. We're gonna have to flip that data a bit. We're gonna go here, and actually, what we'll do, or we can do, just drop it off here. There. like that. Okay, and we're going to sort this based on the date. So what we'll do is we'll copy this. We'll paste it here, escape, highlight the whole thing here. You'll go to sort. Yeah, that didn't do it. You want to sort by that date, by BL. There we go. Yeah, it's the same. October's the same. Good. See how we did that? So we sort of from oldest to, latch in right there, paste. And we'll do paste the dates. Okay. It starts with your data. Really, you can see we're the clock is rolling here. Okay, this was, this took some time. Okay, this definitely took some time. So, yeah. Okay. So we have that. You have the volume and your variety of opens and closes, and like I said, I would just do. That's 2790. Copy. Yeah, the dates are in there from 60. Yeah, from 60. Yeah, 2790. Okay, good. And you can see though we're talking 700 pieces of data. It's December 14th. This last one we'll leave that in there. All right, but it's December 14th, so this is November's 1st and whatever. So they flipped to the last day for some reason. And also these dates, you never want the dates to be that pronounced. Okay, and then what you want to do. You don't want it different like this. So what you'll do is you'll do paste formatting. Okay, I think we did the close. Yeah, we can use the close or something like that. Okay, you can see. So, and we didn't. And actually, what we'll do is, I want to set up the deltas here, the percent change for the year, and just give it sort of a break at that point. Just getting the data set up like this, as you can see, is quite a few. Like I said, I guess what happened was, I guess since the 4 years ago since I downloaded this data, the website, they decided they're not going to allow data back to the 60s or whatever. So, and I'll tell you, getting your data, not that it's going to be difficult, but getting your data is going to, you have to start applying for different historical or different data sites. That was Yahoo. What happens to my Wall Street Journal guys? Yeah. Yeah, theirs went back to remember this went back to 78. So I guess it's a Bloomberg world. I don't know what else to tell you. Okay, so we have we have the index reading going back. We have 800 of them, and these are just monthlies, folks. These are just monthlies, and you have 800 pieces a day. Look at this. You have 755. You have 800 pieces of data or so, and then you have this other thing down here going. Actually, we'll gray that out. So, and also here, uh, we did some sort of annual change here, and we're going to cut this and bring this back up a bit. Like that. There we go. And that's this is your x-axis here, right there. Okay, like I said, I just want to define those, and then we could pick up, another video another day on this. So we have it was 50. The S&P 500 was 56 in 1960, and today's like whatever it is, 4,000 or something. Yeah, today's 4,000. What was the S&P 500 in the late 2000s? No, it's up. It fell off a cliff from 1,000 to whatever. It lost 10% or so to the 800s or so, but it didn't fall that much. The S&P 500. It's 4 times what it was 20 years ago. Yeah, 4 times what we used to be with this. And we'll do this other thing here where we'll take all the Decembers. Yeah, it should be all the Decembers, but we added a year. So, and we'll get to that. We did like a little annual change. You can see just figuring that stuff out is quite a lot. Anyway, so we have a monthly reading going back 60 years. Okay, which is what we have. We had to do the year-over-year change. This was the average of some stuff, I think. These are within the year. These were all the changes from the first reading of the year to the last reading of the year. Okay. So equals parenthesis. You close at 58. You started at 56. You divide it by 56. All right, you had a 4% change that year. And if you want, put on some good music when you do this, because you're going to have to do this, a bunch of times. Because if you just fill it down, it's going to drive you a little bit bananas. So this might be the better. Again, a little tedious, I know, but hey, welcome to statistics. And the computer can't do everything. It can do a lot, but it can't do everything. We're up to 72 already, or whatever it is. Okay, so you can see. Again, this just gives you some sense of the behavior of these markets. '87. We're in the '90s now. '95, a 26% change, a 15% change. So these are the long-term capital management years. So they were benefiting from a lot of things. 20% drop in 2020, but a big rebound in 203. I'm sorry, 202, 203. And you can see though, on average, you're looking at about maybe a 7 or 8% change. You had the Great Recession, minus 32%, then up 51 the next year. Okay, so actually we finished it, right? However many of those were, those 60, I did that 60 times. The annual change, you can find the average of that. And now you get, here's the thinking part. Now we're going to leave with this concept. We're going to do month over month changes. We'll do the current one, and we'll do the previous one. Okay, so the easy place to start is sort of right there, and I just want to I'm just checking myself to see if that's what I did. Yeah, the easiest place to start would be there. The next two, let's see how I did it. So the current one is here. Here, I'm going to do it how I sort of see, and we'll do a comparison. So we'll do like this. And then the previous one, like that. Because this is current, right? And then your last one is the 269. Let's see how that looks compared to what we did a couple our thinking a few. And this is always good to do things like this. Always check, compare your thinking. What I thought in this we don't need right now. What I thought in whatever the fall of 2018 and how I'm thinking today. Yeah, a little different, but yeah. We started with sort of yesterday's version of this. No, it's the same. Yeah, 175. Yeah, that works. Well, excuse me, folks. I apologize. Yeah, because I'm taking T as here, and then T minus 1 is when back 1. Yeah, yeah, that works. So we'll see. Like I said, we'll see how this affects everything that sort of happens here. So take these, we'll copy. Old HV formula. Yeah, let's look at the 2014 numbers there and the 2014 numbers here. Yeah, that's I just sort of how we so here these are our main characters are here. So does yesterday's return impact today's? That's what we're studying here. And that's it. So what we did was, and we'll go back to the beginning of this. So yesterday's return was there, and today's return was this. Yeah, minus 1.75. So I started in a different column compared to last time. Like I said, you can see how complicated this stuff is. So I think this is a good place to put a fork in it for the time being, and we'll have a couple of these, but we're going to continue this. So the next movement is we have these observation dates and all this, and we're going to put the data in and create create some equations, some slopes and some intercepts, and we'll do those kinds of things. But finding the data is the big part of it. Luckily, I had this, and I guess, like I said, I guess the policy changed on Yahoo Finance. We can't go back to the 60s, but we have it that far back. But here, look at in the 60s and the 70s. Now it was a little more volatile, but you had 65. Everything moved about 2% month over month. 3%, 2%. Those kinds of numbers, right? And let's look at today. You had some big swings. Obviously, COVID hit you there, but still similar. 2%, 2%. Okay, +7, a couple outliers. Yeah, a little more volatility. I think we have a little more volatility than we used to. Those are these are the month over month changes, and you go from here, right? You say, okay, I have my index data, I have my percentage changes, and now we'll see. We'll do a random walk analysis of this in the videos that are coming up. But like I said, at least get the data on your spreadsheet, and then from here there's other things that we can do. And actually, just as we're sitting here, I'm just gonna prep myself a bit for sort of what's next. So we'll worry about the annual changes. We'll do this another time. Yeah, this was 28. Yeah, this was 2018 when I did this. This was just getting the data together. See, so the predicted equation, you're gonna compare the predicted equation with the actual, and that's really where you're going to go from there. So, all right, folks, let's wrap it up, and we'll see you next time. We'll see you next time.